Wall Street's bracing for impact. Stocks are rising, recession fears are spreading, and the Federal Reserve looks almost certain to cut interest rates this month. But there's one number, one single data point, that could flip everything on its head. Tonight, we break down what's driving markets, what's at stake for your money, and why inflation may be the wild card nobody can afford to ignore. Futures kicked off Sunday night in positive territory. Dow futures up 94 points, S&P 500 up 0.23%, Nasdaq gaining 0.38%. Meanwhile, the 10-year Treasury yield held steady around 4.09%, while the US dollar gained against the euro and jumped nearly 0.7% versus the yen, thanks to political turmoil in Japan, where the prime minister just resigned after less than a year in office. The rally comes after a brutal jobs report Friday that rattled investors. According to Moody's Mark Zandi, most U.S. industries have now been shedding jobs for months, not adding them. He warned, this only happens when the economy is in recession. That weakness has essentially locked in a Fed rate cut at the September 17th meeting. Wall Street sees a 92% chance of a quarter-point cut, and some investors are betting on an even bigger half-point cut. That weakness has essentially locked in a Fed rate cut at the September 17th meeting. Wall Street sees a 92% chance of a quarter-point cut, and some investors are betting on an even bigger half-point cut. But here's the catch. Cutting rates into inflation is risky. The Fed is almost cornered, jobs are weak, but prices are still running hot. President Trump's tariffs, once feared as inflation accelerants, have had a softer impact than expected, but that could change. Meanwhile, Fed Governor Lisa Cook is fighting Trump's attempt to fire her. A court ruling could decide whether she even sits at the table on September 17. And the Senate may vote on Trump's nominee, Stephen Moran, potentially tilting the Fed's balance even further. Here's the number that could derail it all: inflation. Wednesday, Producer Price Index, PPI, expected to rise 0.3%, cooling from July's massive 0.9% surge. Thursday, Consumer Price Index, CPI, projected to climb 0.3%, slightly faster than July. On a yearly basis, CPI is expected to hit 2.9%, up from 2.7%. Core inflation should hold steady at 3.1%, still well above the Fed's 2% target. If inflation runs hotter than expected, those Fed cuts could suddenly look reckless, and Wall Street's calm could turn to chaos. It's not just U.S. data. Political turmoil is hitting markets worldwide. Japan's prime minister resigned, rattling the yen and raising fiscal policy questions. France faces a confidence vote after bond vigilantes drove yields higher. And in energy, oil rose slightly, $62 a barrel for WTI, even after OPEC Plus agreed to boost production. These cross-currents keep global bond markets on edge, and that matters directly to U.S. borrowing costs. Gold, the classic safe haven, fell about 0.6% to $3,630 per ounce, still hovering near record highs. That tells you investors remain nervous. Oil prices ticked up, but only modestly, despite OPEC Plus trying to flood the market. All of these signs, falling gold, steady treasuries, a strong dollar, point to a market hedging both ways, betting on a Fed rescue, but fearing inflation could ruin the party. For U.S. households, this isn't abstract. Rate cuts mean cheaper mortgages, car loans, and business credit. But if inflation pops back up, your grocery bill, rent, and fuel costs could climb even faster. It's a delicate balancing act, and the Fed only has a few tools left. So here's where we stand. Recession fears are real. The Fed is almost certain to cut rates. But inflation, this week's data, could flip the script overnight. What do you think? Should the Fed cut aggressively to save jobs, or hold the line against inflation? Drop your thoughts in the comments, and don't forget to subscribe for more breakdowns of the numbers shaping your wallet.